In financial markets, understanding price action is crucial for making informed trading decisions. Traditionally, traders have been taught to look for support and resistance as mere horizontal lines on a chart where price seems to bounce or stall. However, there's much more happening beneath the surface of these seemingly simple lines. To fully grasp the mechanics behind breakouts, we must consider the concept of liquidity and the pivotal role of market participants, especially liquidity providers, or LPs. Liquidity is defined as the availability of buy and sell orders at specific price levels. Without this crucial element, markets would struggle to function effectively. Liquidity providers, which typically include banks, hedge funds, and professional market makers, play a fundamental role in maintaining market efficiency by ensuring there are sufficient volumes of trades that can be executed. They achieve this by posting limit orders around key price levels. Support levels, on the other hand, represent areas of high liquidity on the buy side. Here, market participants actively place their buy orders, anticipating that the price will bounce back up from these levels. Conversely, resistance levels are characterized by significant liquidity on the sell side, where traders set sell orders, expecting the price to stall or reverse. This perspective allows us to understand that support and resistance are not just arbitrary psychological barriers. They are critical zones where liquidity accumulates and influences price behavior. When prices begin to approach these high liquidity zones, we often see a slowdown in movement. This phenomenon occurs because a substantial volume of buy or sell orders is able to absorb incoming market orders. For instance, imagine a strong resistance level filled with numerous sell orders. Any upward price movement will inevitably encounter these sell orders, leading to an absorption of buying pressure, which causes the price to hesitate or potentially reverse its course. In the same vein, a well-established support zone populated with considerable buy orders acts as a cushion, preventing the price from dropping further. Thus, it becomes evident that price action often pauses at pivotal levels due to the concentration of liquidity rather than simply because of trader emotions like fear or greed. Breakouts, on the other hand, signify a shift in the liquidity landscape. They occur when liquidity is withdrawn or evacuated by LPs. Interestingly, market makers tend to avoid allowing prices to move too far in one direction without a robust mechanism to manage risk. They accomplish this by strategically manipulating liquidity levels. One common tactic is withholding liquidity, which means reducing limit orders at a specific key level to facilitate a smoother price movement through that level. Another tactic involves actively pulling liquidity, wherein LPs cancel standing orders as the price approaches significant levels of support or resistance. When these dynamics play out, the walls of liquidity that typically contain price movements suddenly disappear. As a result, even a modest influx of market orders can propel prices quickly in one direction. This phenomenon encapsulates the essence of what a breakout truly is. Breakouts are not random occurrences or mere coincidences. They are orchestrated movements predicated upon the actions of liquidity providers who carefully manage the flow of liquidity to either trigger stop orders, capture market momentum, or rebalance risk exposure. Understanding this nuanced relationship between price action and liquidity grants traders a significant advantage. Rather than blindly chasing breakouts as they occur, traders can develop a keen sense of where liquidity might be thinned out, enabling them to anticipate areas where prices may accelerate dramatically. To apply this understanding practically, traders should focus on identifying liquidity zones rather than just treating horizontal lines on a chart as static support and resistance levels. It's critical to look for clusters of limit orders or repeated price reactions that indicate substantial liquidity. These are the real levels where the market is experiencing genuine liquidity. Additionally, traders should remain vigilant for signs of liquidity withdrawal. Sudden gaps in price action, thin order books, or accelerating volume can all serve as indicators that liquidity providers are actively pulling their orders. Moreover, breakouts generally follow liquidity imbalances. Recognizing that a strong breakout typically means that liquidity providers have evacuated one side of the market can help traders visualize an open path for price movement. It's essential to remain aware that support and resistance are not static entities. They are dynamic zones that fluctuate as liquidity providers adjust their orders. Therefore, traders should approach these levels with an adaptable mindset, treating them as zones of liquidity that can materialize and dissipate. In conclusion, support and resistance levels do not represent unyielding barriers, rather, they reflect areas where liquidity is maintained. Similarly, breakouts are orchestrated events that transpire when liquidity is strategically withdrawn. By developing a deeper understanding of how price action interacts with liquidity, traders can improve their ability to predict market behavior with greater accuracy, consequently reducing the uncertainty often associated with trading decisions. If this explanation has provided valuable insights into market mechanics, liquidity dynamics, and professional trading strategies, consider liking this video, following the channel for more content, and turning on notifications. This way, you will always have access to in-depth analyses of the markets from a well-informed perspective.